Welcome back to the live stream hub. My name's Sarah Golden. I'm VP of Climate Tech, and I'm delighted to be joined here by Marina Severinovsky, who is head of Sustainability America at Schroders. So to start out, Marina, tell me a little bit about your role and what Schroders does.
Thank you so much. So Schroders is a very large asset manager. We're based in the UK. We're listed on the FTSE 100 in London, and we have about $800–900 billion. And we do, because we're based in London, our kind of epicenter of sustainability sits there. But we have regional hubs in the Americas, in Europe, and in Asia. So I oversee one of those investment hubs. And we basically work with both our internal clients, who are our investors, our PMs and analysts, as they focus on sustainability in their work and their investment. And then we also work with our external clients to help them understand what we're doing in sustainability and also in impact.
And what kind of clients are those external clients?
So our external clients, the entire gamut, but basically institutional clients like pension plans, endowments, foundations, insurance companies, and then also on the intermediary side, kind of more like wealth clients. So all the way down to, we partner with actually another entity that sort of distributes our funds in a mutual fund format down to individuals as well.
So I've been witnessing this way that finance and the way that we've been trying to apply our dollars to make different impacts has been a little bit of a rocky road in the last few years. And I'm curious, given these clients that you work with, how have you seen that demand for sustainability evolve?
Yeah. So I think that there was a moment where it was just really easy to pat yourself on the back and say, I'm a genius. Sustainability works, because what was working is that oil prices were very low and inflation was very low and interest rates were very low. And the companies that tended to look really good as sustainability companies were sort of large, very, mega cap, a lot of times in the US, technology, consumer discretionary, communications companies that people were buying a lot of anyway, and they were performing really well. So you could sort of say, well, that's a sustainable company, or you could just say, well, that company has sort of less carbon intensity because of the nature of its business, and it has highly paid employees. There's less kind of social or labor issues, and it has a lot of people who can write great policies, and so then you have good governance as well. But that's just kind of incidental, right? The trick is, in every kind of market, you have to be able to manage through. So it wasn't as easy after Russia invaded the Ukraine and energy prices went up and inflation is high and interest rates are high. And all of a sudden, you can't just look like a genius buying those companies. You actually have to be more thoughtful. And the question is, if I am holding more carbon intensive sectors, how do I manage that? How do I engage with them? And so we're kind of redefining what it means to be sustainable. We talk a lot about transition and holding companies that may not be so green at the moment, but they're trying to evolve over time, and you're supporting that evolution as an investor. So I would say, I think people are trying to understand this over time, that there's a maturation, I think, of understanding of what it means to be sort of investing in sustainability, that it's not the kind of easy win, that it's actually a pretty long-term commitment. And when we talk to our clients, a lot of it is about kind of what matters to them, because sustainability is so broad. There's climate, which we talk a lot about, and we're at Greenfin, but there's also social issues and governance issues. And so you can approach clients from many angles and say, what to you is a good company that will persist and be durable over time? Like, what are the characteristics you want to focus on for that business? And there's many different ways that people can articulate what matters to them and also what they see as a company's important characteristics around their risk and their opportunity that'll make them successful long term. And that's what we hone in on as being sustainable.
Are you seeing this as being a true metric for how people are investing their money? Are they willing to accept lower returns if it means that they're meeting one of these other criteria?
Yeah, I mean, I think that that's a little bit of a misnomer in the sense that, like, to accept a concessionary or lower return, you have to move into what I would say is impact investing. And we have to be really careful to call impact with a capital I, impact, right? That's where you can say, look, I really want my money to do something other than make returns for me. I really want my money to have this other motive. And that's completely fine. But for the vast majority of, let's say, pension plans, that's not even permitted, right, legally. So that has to be like, could be a family office, it could be a foundation, it could be somebody who has that mandate. For the vast majority of clients, what you're talking about is taking into account climate risk, or indeed like opportunities that a company can be like putting products or services into a trend that is actually going to make them more money potentially, right? So you're not talking about a concessionary return. You're talking about, again, a way to think about how can a business be less risky and more durable over time.
Well, thank you so much for your time here today and
Yeah.
helping illuminate some of this path that we've been on.
Thank you.